Good morning, evening, and afternoon, wherever you're watching this from. It's great to have you on board. Don't forget to get my free training underneath this video and follow me, like, share, comment, subscribe, wherever you're watching. So I'm going to do a US index video today. I'm going to do it with good reason. Later on today, I believe I've got my news on the right-hand side. You've got Fed Chair Powell doing a speech. So that's Thursday, the 9th of November, which is today. Now, there's a lot to discuss within US indexes, particularly. I've got loads of people who are members of mine in my academy and also non-members who are asking me about it. And there's various different parts of it which you need to consider if you're trading it. And this goes for everything. It goes from the long bias and the short bias. Really in between that is having a core risk management understanding and how to manage your entries based on what's happening, essentially. So that's why I've got your S&P mini futures on the left, and I've got your US100 Nasdaq on the right. So what's really significant straight off the bat is that you have been downtrending for a significant period of time. If you look back to the start of August, end of July, that's where you peak. Of course, you come down here, so you've got your you've got one low there, and you've got a lower high there. You then get a lower low there, okay, and a lower high. At this point, as it stands, you've got a lower high and a lower low. So clearly the trajectory is moving down. Obviously, if you look at the NASDAQ, you can see much of the same. It's just a series of lower highs and lower lows. As you probably well know, that is what forms the basis for any downtrend. And it's because what's happening is the market sentiment has persisted to the downside, moving the market down and down and down and down and down. Now, the key thing to understand, first of all, is that these downtrends on what I've got at the moment as a daily chart consist in the overall uptrend on the higher time frames. That's the point in multi-time frame analysis. The point of it is to understand that really all time frames do is allow you to view the data that is on your screen in terms of how long it's probable that the trade is going to take. So if you flick up to something like a monthly chart, okay, not quite 3 monthly, but monthly, you can see obviously it takes you on a longer journey of candlesticks, okay? So it shows you the long-term market effectively. So although you have been downtrending for a period of time, you may find that that is in line with the overall uptrend, which currently you can see it is on the very long term, probably more applicable on your 12 monthly or something like that. So on the basis that you have had this continuous downtrend for several months now, we're in the cold November months over here in the UK. But given you've had that, and really given you've come from the 27th of October all the way to now with straight green candles up, it really has to be said, in my opinion at least, I would rather be short biased. Now, the reason why that is the case is for several different reasons, okay? So I'm going to go through those individually. Now, number one, of course, you've got global tensions and you've got problems now in China that caused the market to start to fall. So that's why you got that really, really fast continuation down because you can see that economic conditions or the fears in the market specifically are what are causing people to sell. Now, once you come right down and you get onto NFP Friday, like we had last week, and all the comments from the Fed that were slightly better, they were saying, okay, well, maybe things are all right and we've done okay with our monetary policy. That has fed straight into the optimism. And that is why you've got such a harsh move up. So you've gone from having these real fears about tensions globally, okay, in the Middle East, slamming the market all the way down because people are like, wow, I need to get out of my stock holdings. I need to get short. I really don't want to buy this, to suddenly an easing in tensions and an increase in the positive market sentiment. Now, the thing with trading is that whenever you're making an assumption, a lot of the time you're only going to get the best amount of value for your trade, okay, or the lowest or highest price before that sentiment changes. So that is all markets are. I mean, they're literally good news and bad news, or buying and selling and buying and selling, okay? After all the good news comes the bad news. After the bad news comes all the good news. Okay, that's just how things work. So anyone who says, you know, you need to buy highs and stuff like that, it's just nonsense, because you're never going to find it. Happened in gold. People said buy the highs on gold because gold has got positive market sentiment. People are putting their money in the safe haven because they're worried. And now suddenly they're not worried as much. Everything's okay, and the gold price has come right down, and they're all stopped out. So if you're one of those people who are saying, "Wow, you know, the U.S. economy actually looks all right," you're forgetting that you could have global tensions increase, spillovers from China, just like the Federal Reserve Committee has just said. Okay, they've been talking about the potential for spillovers in China. It was Fed's Cook who said that. Okay. You know, China is a massive economy. If it slows down, it's going to spill over and affect the rest of the world. So if suddenly you had some news saying that, you could expect this downwards trajectory to continue. Okay. And if you're one of those guys who's a breakout trader as well, because you've seen the downtrend come down, you've seen this point, like I said, the same problem persists. If you're buying after the up move, okay, and you only know it's a breakout because it's broken out, if suddenly the news changes, guess what's going to happen? Okay, you're going to find it goes like this, just like it did with the geopolitical tensions. Okay, the same thing happened. People started to say, well, this is a little bit risky, and the price falls. Now, if you look at the NASDAQ, you can see you've got a slightly flatter downwards trajectory because there isn't that strong overall market sentiment. The US100 consists of different entities. So you can see you've come up, your stock oscillator is way high up on both. Okay, they're somewhat mirrored, but like I said, the US100 is a lot more flat at the moment. So my bias really is this. If you're someone reading the news saying, okay, well, the Fed's saying perhaps in the US they're slightly better off jobs data wise, and they're handling inflation or whatever they say they're doing, it doesn't really matter. You know, it's about what they say, which moves things. If you're someone who's buying on that, personally, I don't think that's a good idea because you've already rallied from this point. Now, we called it long. You'll know if you go and look back at my post, I called it long at both of these lows. I said you're coming to significant key support. Okay. Oh, I've just removed my indicators. I'll get those back in a sec. You're coming to significant support and you rallied straight up. Okay. It's actually quite ideal that they're gone now because you can see more clearly, more or less via a naked perspective, the points I'm making. Okay. You came right down, very solid PA, right where I've drawn the center of that eclipse down here. And you had severe rejection, straight up, boom, okay? And now you can see that you've got elements of minor price action to the upside. So like I said, if you're shorting this and you can see the market sentiment has changed so it's strong, you simply need to deviate your risk size. But absolutely, I wouldn't be buying this. I wouldn't be shocked whatsoever if you do come even higher than you are now. And if you want to hold off for risk-averse shorts, that may be ideal. But my bias is absolutely short, and it just comes in line with natural market trajectory. You would have had the same rhetoric about buying up there. You would have had the same over here. People would have been saying buy these highs every single time. And if you look back, they've all lost money. Okay. So because the market sentiment is strong, in other words, the market's rallying and rallying and rallying, I would consider lowering your size based on that inherent market risk. Okay, and that goes for the S&P, the NASDAQ, the Dow, whatever it is, US index-wise, my bias is the same. I think there's potential you may rally because you've got that strong sentiment. I don't think it's done yet, but you've got to remember that that strong sentiment has to end at some point, just like the negative sentiment ended at some point. So you had an enormous fall, 4, 5, 6, 7 to 4, 1, 2, 3. Okay, very long way, 440 points. And now you're just getting your rebound. You would expect coming to such strong support that would occur. Okay, you would absolutely expect that because it's unlikely you would just bounce straight through. In fact, someone asked me very specifically about this. Okay, and I mentioned to him, okay, well, if you're looking for swings, it's going to be ideal because you've got key price action, you're coming to some early MAs, and, you know, nonetheless, it's a fall. You're back where you were when you started, but it's a fall from 15,300 to 14,100. You would expect on such a significant fall that would occur. Now, again, you would have had tons of people at this point who are saying, you know what, I can't buy this because the sentiment is terrible. We should be selling. We should be selling all indexes, selling the stock market. You know, everything's crazy. It's never going to stop. And then suddenly the price is now up back to where we were. And everyone's saying again, we should be buying the indexes. Everything's fantastic. We're not going to get a fall. Okay. So it's this complete double standard every time. People who lose money trading and don't know what they're doing, okay, the vast majority will say things like that. They'll say buy the highs, sell the lows, and then when it goes wrong, they deny it and they do it again and again and again and again and again. So you will find people who make money, or in fact, institutions will be looking at these higher prices and saying, you know what, perhaps I can achieve value at these points. Perhaps when the market does ride to these points, it's going to be far more feasible for me to catch a larger fall than rely on the small amount of movement I've got till I reach the next level of resistance. Okay? Or in fact, where people may consider shorting their orders. So it's just a case of understanding that if you're coming to resistance levels, it's likely you've already rallied. And please note as well, in 2 weeks, we're not even finished the second week, you've already come, a considerable way. Okay, so like I said, you've got a diminished amount of time left until you hit key resistance where people are short. You've got a significant profit margin should there be a fall, just like you had here. So it's all about profit margins at any time. Okay, and the bigger the profit margin, i.e. the bigger amount of room from resistance to support in this case, because we're short, the better. So it's completely up to you how you do that. But that is my take on US indexes like the SPX and the NASDAQ, US100. Thanks for watching, guys. Hope it helps. Don't forget to get my free training. Like, share, comment, subscribe. And of course, as always, I'll see you in the next one. See you there.